Welcome to a brand new series we are doing on the podcast called Fintech Revealed. This is where we go deep on one topic with a couple of subject matter experts. We are kicking off the first episode in the series with one of my favorite topics, cash flow underwriting. Joining me on the show today is Kevin Moss, formerly with Wells Fargo and SoFi, and one of the most experienced credit executives in the country. Also joining us today is Alex Johnson, the founder of Fintech Takes, another credit expert and someone who has written extensively about cash flow underwriting over the last year or two. But before we kick it off, a word from our sponsor, Prism Data. The team at Prism Data have developed their cash flow underwriting solutions over the course of nearly a decade and billions in credit originations, resulting in a mature, reliable, compliant system with the most predictive power available in the market. It starts with the cash score, Prism's simple 3-digit credit score for automated cash flow underwriting. And if you want to go deeper, Prism offers thousands of data insights and attributes to power even the most sophisticated risk models and strategies. Learn more at prismdata.com. Welcome to the show, Kevin and Alex.
Thank you.
Thank you, Peter. Good to see you.
Good to see you guys. So for the very small minority of the audience that don't know who you guys are, why don't you do a quick intro? Kevin, we'll start with you.
Happy to be here. Kevin Moss, former Chief Risk Officer for SoFi, 31-year banker, Chief Risk Officer at Wells Fargo and consumer lending. Do a lot of advising in 3 principal areas with startups and some banks: fraud, banking, and lending.
Okay. Alex?
I don't like to introduce myself after Kevin introduces himself because it's embarrassing. But Alex Johnson, I write a newsletter called Fintech Takes that analyzes the intersection of finance, technology, and public policy, and am a lending nerd in my heart of hearts. So excited for this conversation.
Yes. And you also have a wonderful podcast. So let's kick it off. We're talking about cash flow underwriting. Maybe we start off with, how is cash flow underwriting different to traditional underwriting? Kevin, why don't you take that one?
First, you have to define what cash flow underwriting is. And I'm going to keep it a little bit narrow. People have checking accounts. Most people, in fact, 96% of Americans have a checking account. Inside a checking account, you have debit transactions, ATM transactions, ACH transactions, checks, P2P between 2 people, merchant credits. And so through the use of deposit aggregation with companies like Plaid and Finicity and MX, the availability of deposit transaction data has now become commercially available for on demand with people entering their credentials. And you typically can get up to 2 years history. On average, it's about a year that you get. And you get the raw transaction history associated with that. So cash flow underwriting is about taking that raw transaction history from the deposit account or other accounts and creating useful attributes or features that could be in models that summarizes the information value in that transaction history. And so cash flow underwriting, which people have affectionately called it, which has some type of implication around thinking about your inflows and your outflows and how much cash flow you have left over. Really what it is in practice is the creation of attributes that have information value in predicting probability of default, and then using things like machine learning and other statistical methods to build models and strategies around how to underwrite credit in the same way that the FICO score or Vantage score does. And it does a very, very good job, particularly in situations where somebody might have less or no credit history, which is unfortunately, and we'll talk about this later, quite a few reasons why there's quite a big population of people that traditional credit underwriting doesn't serve as well as cash flow underwriting could.
Right, right. So, Alex, I was curious. I was reading your newsletter a while back. You had a big thing on cash flow underwriting, and you were talking about the CEO of FICO from decades ago. And like he was talking about cash flow underwriting, and you were making the comment that you thought they would not have been all that into it, but he liked it. But explain to me, you used to work at FICO, explain to me why cash flow underwriting is not part of the FICO score.
So Larry Rosenberger, who was the CEO of FICO in the 90s, he is on record as saying we would have used the data if we'd had access to it, right? And so I think to Kevin's point, using data on someone's cash flow and how much money they have and how much money they spend on a recurring basis, that's a very logical underwriting signal that's very useful. It speaks very directly to ability to pay. It speaks really directly to stability of income, all these factors that are really important for underwriting. The reason that it's not captured in the FICO score is simply that when the credit bureaus were first formed, and then when they were kind of digitized in the 1960s, 1970s, 1980s, and they sort of consolidated into the three credit bureaus we have today, they were built very specifically to share very specific attributes on repayment behavior, right? And so the bureau file that we know today was really built to capture a very narrow, specific set of data, originally that retailers actually had more so than banks and other lenders. And then over time, banks and other lenders became more the big contributors to the credit bureaus. But the only reason that we don't have this data in the FICO score is that the FICO score was developed before we had sort of machine readable access to it, right? And so there's no real valid reason why, as Larry Rosenberger said, they would have used it if they could have, because it is a very valuable and useful signal that's deeply complementary to the data that the credit bureaus do have. And I know we're going to talk about this, but we've seen even FICO try to adapt to this shift in cash flow underwriting that's been driven, to Kevin's point, by open banking and the ability for consumers to programmatically share access to their bank account data.
Right.
And Peter, one thing I want to say is, as a banker for 31 years, I actually was using deposit transaction attributes as early as 2002, 2001, 2002 for on-us deposit accounts. But the open banking really opens up the opportunity for off-us, where you may not have the deposit account, to get the same type of data that you would have on your own customers.
I just want to dig into that, Kevin, since you brought it up, that I think you worked at Wells Fargo, right? That was the bank. And so you're saying that you were using the information contained in Wells Fargo customers' checking accounts to underwrite? Is that what you're saying?
Yeah. I mean, without getting into the specifics of it, I used to think about what was a retail bank's secret sauce. And it was that most of the time, the first relationship that someone established with a bank was opening a checking account.
Right.
And the fact that you had both sides of a consumer's balance sheet inside that, like banks today, I would guess close to 70% of their checking accounts have some kind of recurring or direct deposit going into it as the primary checking account where their income goes. I could see both sides of a consumer's balance sheet and make a really good assessment by just a very small number of attributes that summarizes a lot of good value that came out of that. Today, with Prism and Nova and Truve and a whole bunch of others, there are literally tens of thousands of attributes that have been built to summarize what the transaction history represents. But even back then, with a very simple I had about 100 attributes, I could increase the separation from a modeling standpoint of goods and bads 10 to 15%, just by adding in some very basic deposit transaction history.
So why aren't we seeing that in more you don't hear about banks using that data today? Were you unique in that, or are banks using some of those, just a small number of attributes?
I think I was probably ahead of most other institutions in recognizing the value that deposit transaction data provided. I'd be surprised if more retail banks are not using some of that deposit data today in credit underwriting. Okay?
Right.
Now, there's a lot of issues around this that we'll probably talk about as we get more into this that you have to think about. Certainly things like when you get into transaction data, sometimes using transaction history is very hard for a consumer to understand why you took adverse action on them. So you have to be very careful in the construction of the data that you use so that it's understood and explainable. And also, you have to be careful about the fair lending implications for it.
Right.
But, having done this for more than 20 years, all of those things, if they're thoughtfully considered, deposit transaction data can be a very valuable source of underwriting capability.
Right. So then, Alex, turning to you then, what had to happen for cash flow underwriting to become more mainstream? And I wouldn't say it is completely mainstream yet, but it's certainly much more than it was 4 or 5 years ago. But what had to happen for that to really come into the consciousness of, chief credit officers and risk officers around the place?
Yeah, I mean, I think there's been a couple of things. One is obviously the access to the data. And I think that's by far the most important, right? And so the progress we've made in the US to date around open banking and enabling consumers to share their data, that's been huge, right? Because until then, it was only someone like Kevin at Wells Fargo who had a lot of honest deposit data where you could use this meaningfully at scale to help improve your underwriting advantage. But if you weren't an incumbent, you didn't have to use this data. And I think getting to the question you were asking before, a big reason a lot of banks didn't is that it'd be nice to get a marginal lift and maybe approve a few more people or maybe be able to price some a little bit better. But the reality is banks were in a privileged position of kind of being the sea lions that got into the dam where like there were so many fish that they didn't really have to worry too much about being efficient and they could just kind of do what they did. It took fintech to put some pressure on them, right? And so what happened was we had the development of open banking, which was market-led. It wasn't driven by regulation. And one of the earliest sets of use cases around open banking in the US was cash flow underwriting. And so you had fintech companies like Petal is a good example that would underwrite borrowers, specifically ones who had limited or no credit history, using cash flow data as a way to do that. And so you had some very early companies sort of demonstrate the validity of this as a way to attack the market, as a way to potentially sort of peel off customers who otherwise would have just tried to get on the treadmill of working with banks and going through that whole process of getting credit when you don't have credit and that sort of catch-22 that we're all familiar with. They were peeling these customers off saying, you don't have a credit score, but that doesn't mean you haven't demonstrated financial behaviors that you could share with us that could be used to underwrite you. So I'd say after open banking, fintech companies coming in and sort of demonstrating the validity of this model at a small scale was really, really important. And that was say circa like 2015 to 2020, roughly. And then around that same time, you also started to get regulatory interests in cash flow underwriting. Cash flow underwriting is one of those topics that's just awesome for regulators, right? I mean, most of the time when regulators weigh in on a new trend or a new topic, they'll sort of be a little not totally on board with it, right? Because you like innovation as a regulator, but you don't want to give full-throated support to innovation that could hurt consumers. Cash flow underwriting is sort of unique in the sense that it's really seen by regulators as a way that's just going to be positive for the most part for consumers. If we can consider data beyond what the credit bureaus have, we can bring more people into the credit system. If there are people who have damaged credit profiles who are being pushed to more predatory forms of credit outside the mainstream, cash flow underwriting can bring them back into the market. It can lead to better pricing even for full file consumers and a more efficient credit system. So regulators tend to love almost everything about cash flow underwriting. And there was a very concerted effort on the part of the CFPB, who just recently finalized their rule around open banking, the OCC, who had a project called Project Reach that was focused on expanding access through cash flow underwriting. Regulators did a lot of outreach to the industry to try to encourage not just fintech companies, but incumbent large banks to experiment with cash flow underwriting as a way to improve access. And I would say it was the combination of infrastructure improvements, fintech competition, and regulatory sort of approval in soft quotation marks that allowed for cash flow underwriting to kind of emerge to the point where it's at now.
I have some points of view which some people may not like about the why part of this. So first off, the why didn't banks move more quickly? Because deposit systems and credit systems operated in very different worlds. And it wasn't easy, even in my prior banking life, to set up a process where you could get access to a file and have attributes calculated correctly and then available for credit underwriting and ultimately built into, any kind of credit scores, for example. Okay. So the separation of the way banks operate, deposits operates like in the retail bank, the community banking side, very different than where the credit card business typically operates. And getting those two together is not, from a technology standpoint in a bank, because many banks are not on modern tech platforms, not the easiest thing.
Right.
My point of view on the reason why regulators like this is there's been so much talk over the years about how the traditional credit system leaves so many protected classes behind. And simply, these are roughly the numbers. We said 96% of the people have a checking account. When it comes to becoming a banked customer, the checking account is the easiest account to get qualified for. If you're not a fraud, you can get a checking account. It's just that simple. 96% have some type of transaction history, let's say, associated with them, or the majority of those. In the credit system, Alex brought up the subprime. Like, the subprime operate in a different world, and there are separate credit files for the subprime customers. And the prime world typically doesn't interact very much with the subprime credit files. And so to some extent, I think when it comes to fair lending and fair access, I think the checking account, because of its deeper penetration, offers a broader outreach and opportunity for people who are in the full spectrum credit world to get access and consideration by lower priced, more prime or near prime lenders. Whereas in the traditional credit system, and Alex and I have written about this, there are specialty files. And those files create separation, in my view. Like, if you were designing a credit bureau system today, you would never design it based on, like, we're going to have a separate file because this is payday lenders or buy here, pay here. You'd figure out a way. The current credit system hasn't accommodated all of the different types of credit products that are out there, including fintech product innovation.
Right.
And therefore, it's created this segmentation, which acts as in my view, as a barrier to entry into the prime credit spectrum. So I think cash flow underwriting creates greater outreach and opportunity for those segments that travel in the world that are separate and segmented from the traditional credit system.
Yeah, that's really, really good point there, Kevin. That's really, really interesting. So before we go any further, though, I want to kind of clarify something, because you often see the term alternative data thrown around, and cash flow data is also thrown around. How is cash flow data different from alternative data?
In broad senses, one of the problems with alternative data is that alternative is just anything that's outside the mainstream. And so Someone I talked to one time was like, alternative data is like regular data, but they're rebelling from their parents and they dyed their hair a crazy color, right? Like that's alternative data. I think in a traditional sense, the way we've defined alternative data is kind of going to Kevin's point. It's repayment data that is similar to what's captured in the Bureau, but for whatever historical oddities was not captured by the Bureau, right? And so alternative data at various times has been considered telco data, utility data, rent data, payday loan data. And as Kevin illustrated before, the bureaus have had sort of an interesting push and pull relationship with alternative data over time because, obviously they want to capture as much of this data as they possibly can. A lot of that data has been brought into the core credit file over the years. The credit bureaus have a lot more rent and utility data than they used to, but a lot of it also tends to get segmented off into separate files that have separate sets of attributes built on top of them and that aren't sort of integrated into the core credit file. So there's some interesting infrastructure challenges to incorporating alternative data. Cash flow data, by contrast to Kevin's point, it kind of gets almost back to the more original approach that we used to take in the old days to underwriting, where we really would underwrite you as a bank based on your checking account and your income and your employment and your just sort of general financial situation. So in a lot of ways, it's more core and more traditional to underwriting, even than a lot of forms of repayment data, and kind of gets us back to that core area. Again, the difference is that unlike alternative forms of data, the cool thing about cash flow data is it's largely being shared through consumer permission, right? And so I think the other aspect to remember to all of this, and it really does relate to how lenders think about using this, how this stuff impacts the credit bureaus. We've never really had a large-scale source of insight that's been used for underwriting that has been directly and granularly controlled by consumers, right? And so that is a pretty big distinction between this and other forms of alternative data, where even if it's like your rent or utility data, if it's being furnished by someone, you as the consumer checked a box somewhere one time, and then it's being aggregated and collected without you really being aware of that happening, and it's being stored by someone, whether it's a traditional credit bureau or one of these sort of alternative credit bureaus that have popped up over the years. Consumer permission data, which is the backbone of cash flow underwriting, is totally different because it is something that you as a consumer, every time you're applying for credit, are explicitly granting permission to use this data. And in fact, under the new rule that the CFPB just finalized, that permissioning process is becoming even more granular and transparent and restricted, right? There's even less ability for lenders or for other third parties that get access to that data to use it in other secondary ways. So it's a big shift, not just in terms of the type of data as we've been talking about, but also in terms of the mechanism by which that data is being shared.
And, just to add a couple of things to what Alex said, some of it is also like Alex talked about the history of how credit bureaus evolved. Well, in the deposit world, check system and early warning were the CRA entities for deposits, and they were negative bureaus. They existed where if someone had a forced closure of $100 or more in hard principal balance, you'd report them to check systems or early warning. It'd stay out there, I think, for 5 years. And then somebody would be blackballed from getting a checking account at another institution that happened to use those services. And frankly, neobanks evolved to originate and support those customers who got pushed out of the banking system because of early warning and check system, right? Because they advertised no credit checks. But the real value, in my opinion, of cash flow data is the positive information, just like the real value in credit bureau data is also the positive trade line history. So, open banking has enabled people to get access to the full transaction, not just the negative stuff that's out there. Certainly negative stuff helps in finding the risky people, but I think the exciting thing about cash flow data is how it can create access to credit for fair price credit to a whole bunch of people now who might not have the same opportunities without it. The thin files, the immigrants, the people who are in the cash-based society that operate in a different world than most of us do. And that's, to me, the opportunity, the mission, if there is one associated with this, is to create greater access to fair price credit to a whole bunch of people who've had challenges through the traditional credit data.
Are you looking for a way to say yes to more customers without taking on additional risk? Do you want to lend more profitably without sacrificing growth? How about both? Cash flow underwriting is a game changer in consumer lending, and Prism Data is the modern cash flow underwriting solution that makes it possible. It starts with the cash score, Prism's simple 3-digit credit score for automated cash flow underwriting. And if you want to go deeper, Prism offers thousands of data insights and attributes to power even the most sophisticated risk models and strategies. An increasing number of lenders, from top 10 credit card issuers to fast-growing fintechs, have adopted Prism's solution to bring the value of cutting-edge cash flow underwriting to their businesses. Using Prism, clients have been able to achieve double-digit percentage improvement in their approval rates without taking on additional risk. With open banking, it's easier than ever for consumers to share bank account data. Prism is the tool you need to put that data to work. The reason we have this is becoming popular is because it is predictive, right? So how well does cash flow data predict default risk?
It's very well. And it depends on what your use case is. So I'll give you a whole bunch of different use cases. For someone who has an 800 plus FICO score, a long credit history, it might make a marginal difference, but it's not going to change your credit decision. For someone who has one trade line, who's been open for 6 months, you can get a Vantage score. But the value of that score, in my experience, is very limited. And the reason is because it's based on very, very limited information about that customer. Now, if I have a deposit account and I have a couple of years history on that, and I can see what their income is, what's coming in, how their expenses are going out, at the end of the cycle every month, there's still some cash left over. I don't see return items or overdrafts. I see responsible use of that account. That tells me a lot more about that customer than I can ever learn from the credit bureau. So to me, the value creation that this data has is much more beneficial as the value of the credit bureau data diminishes. And that could be subprime credit, where I could use this data to really pick out, like what you find as you get into deeper subprime, the FICO scores and Vantage scores, they don't do a great job. And because most of those people look alike. But I can take 2 deposit transaction histories and find a lot more information value out of someone who is managing to pay their bills through their deposit account, their utilities, their rent, their mortgage, whatever it is, than I can through only the credit side of the balance sheet, where some of that stuff is reported and some of that stuff might be spun off into another credit file somewhere where I don't even see it. I can see buy now, pay later. I can see things in the deposit account that the credit bureau has no representation of, whether it's because it's in a separate file or it's not reported at all. I can see rent to own. I can see payday. I can see that stuff. And the people who have the deep experience in building attributes out of the deposit transaction history can isolate those as separate attributes that can be used to really assess the risk of that customer. So the bottom line is that if you can get the right attribute set coming out of that transaction history, you can have insights into people, much deeper insights about what they're doing, what products they have, than you can see in a credit file, particularly one that has very, very limited history on that customer. So I'm extremely bullish on the opportunity for fairness, on the opportunity for credit access and penetration into underserved market segments. Now, Alex brought up a great point earlier, which is lenders are discouraged because it's permission data, because it creates friction in the funnel.
Mm-hmm.
So who are people using it for today? They're looking at it for second looks, for people they declined. They're looking at it as an opportunity maybe to offer better terms if they give them permission to look at their deposit account. They're looking at it for thin files and no credits, and they're using it to underwrite subprime. But those segments are not the majority. They're relying more on the traditional credit bureau data for the majority of their applicants. Now, once we get to the point where the opportunity to use an aggregation solution becomes tokenized, what that means is if I have my checking account at Chase and I'm SoFi and someone wants to originate a loan with SoFi and SoFi wants to see the Chase checking history, a customer will be able to authorize the one-time use without putting in their banking credentials at SoFi. And so once that happens, right now, something like 50% of the people on average opt out because they're uncomfortable sharing banking credentials. I think once tokenization happens, I think we'll see a much greater adoption of this, okay? And by customers and also by lenders. And then at that point, I think we may see deposit transaction data be a real competitor with the credit bureaus.
Interesting.
So I think it's a few years away.
Right.
But 5 years from now, I think it's very possible that deposit transaction data could be on par with credit bureau data.
Interesting. Alex, I think was it you that wrote about it? Someone might have been Simon Taylor, but anyway, I'll ask you anyway, Alex.
Don't mention Simon's name to me. No, I'm just kidding.
How would that work? What would that look like when there's a tokenization that Kevin was talking to? What would that look like for the borrower journey?
Sure, yeah. So as Kevin was saying, I mean, the concern on the part of lenders is we just spent 20 years figuring out exactly how to do online account opening in the way that introduces the minimum amount of friction. And now you're telling us we have to smash all our work with a baseball bat and start over, right? Like they don't want to do it. For all of the great things about open banking, it's not the most reliable infrastructure in the world today, right? Like, let's just be honest about that. I mean, we've made a lot of progress, but if you talk to someone who builds on this as critical infrastructure, what they will tell you is it breaks all the time. Screen scraping is really unreliable. This aggregator just got in the fight with this big bank, and suddenly that bank turned off their access to this data aggregator. Like, this stuff happens all the time. It breaks. It doesn't have perfect coverage. So there's a lot of concern that the friction that you introduce into the borrower journey by putting that consumer permissioning step at the very front of the experience, the friction and the abandonment rate won't be worth the increased ability to underwrite accurately, whether it's subprime or full file customers, right? So, as Kevin was saying, what we're hoping for, and I think the rule from the CFPB that's now been finalized should be a step in the right direction here, is we're hoping for more seamless and reliable infrastructure to build on. And so I would say the two things that will help improve us there are, one, just the move from screen scraping and a sort of reluctant data provider community, meaning big banks, to one that's more uniform, right? Where under the new rule from the CFPB, everyone will have to stand up a developer interface, aka an API. That API will have to have uptime and performance standards that you can't really monkey around with. And so, one, the basic access to transactional deposit account data should become a lot more reliable. Coverage should be more even. Connectivity should be more solid. So there won't be as many of those concerns. And then the second layer of concerns is, even if that consumer permissioning step is more reliable and it doesn't break as much, there's still the natural friction of, okay, you're asking me to plug in my username and my password. Do I remember it for this bank account? There's all kinds of sort of things that are just naturally friction filled as a part of that experience. Consumers have gotten a lot more trusting in doing this over the last 10, 20 years, but still there are consumers that are a little nervous, justifiably, about handing over their banking credentials, especially when they see scams and other things happening at a greater rate these days. So there's just a sort of natural reluctance. And I will say, we've been sort of maybe being softly critical of the credit bureaus in a lot of ways. One thing that's really great about the credit bureaus and the credit file, it's super low friction to get access to, right? You plug in your name, your last four of your social, your date of birth, and you are away and you don't have to do anything else. Open banking is a little more friction filled to interact with. So as Kevin is describing, the other big benefit is going to be streamlining that authorization process so that instead of having to plug in your username and password, and this is how it works in the UK, by the way, if you're using open banking for a payment use case, the experience for the consumer is just, do you want to just connect to your bank in order to streamline all of this? Yes, I would. Okay, great. We're going to send a tokenized request to your bank. They're going to give you a notification on your phone that's going to pop up. Your mobile banking app on your phone pops up and says, hey, so-and-so's trying to get access for a thing. Is this you? You go, yes. You use your biometrics on your phone to authenticate it so you don't even have to log into your mobile banking app. It sends the tokenized approval back to the requester of the data, and away you go. You don't have to type anything in. The whole process takes a second and a half, right? That is the experience that if we get to that, we will have streamlined a lot of the friction. And at that point, I agree with Kevin, we will see lenders put open banking at the top of their workflow, and we'll be asking for that as a step at the very beginning because, absent anything else, you would want this data. And as a consumer, the more data I can easily share that's going to give me better odds of being approved or more likely to get a better price, the happier I'm going to be, right? So there's really no objection on the part of the consumer as long as we make it easy.
Exactly.
Then let's talk about the lenders. Today, what types of lenders are using cash flow underwriting for second looks, shall we say, and what types of products are they using it for?
I would say cash flow underwriting is deeply penetrated into deep subprime lending. Several, I've worked with one or two, several well-known deep subprime lenders rely exclusively. They won't even pull a credit report. They rely only on the cash flow. And the reason is they will use the deposit transaction history to estimate what people's incomes are, to establish their ability to pay. And then they will use the inflows and outflows and have created attribute summaries that their models and policies are based upon. And someone might be borrowing a few $100, but it works very well. It works better, quite honestly, than the subprime credit data does for them. So I would say that's one area that it's deeply penetrated in. I would say the second area is, I would say in the BNPL space, people are using it and playing with it. It's got a lot of potential because BNPL, again, is like a non-prime, near-prime customer. I think in the long run, in BNPL, there'll be, I think, broad adoption, especially when tokenization takes place. And quite honestly, I think the place that is in the top of the first inning in baseball terms, it's ironic that we call it cash flow underwriting, but the place that I think that has one of the most promising opportunities is in measuring ability to pay. People, and this is not something that has taken off broadly. People think about this as a replacement attributes and a replacement for their credit score. But actually, like debt to income, other than for a mortgage transaction, because in a mortgage, most of the time, both earners in a household will apply. You'll get both incomes. You'll dedupe the debts. But in a lot of consumer transactions where only one person applies, but you might have joint debts, for example, your mortgage, in a lot of cases, debt to income is wildly inaccurate when it comes to consumer credit underwriting. I think cash flow underwriting has the potential to completely replace the way consumer credit thinks about ability to pay. But that has not really been the major focus for cash flow underwriting yet. So I think it's to come, and I think it's going to be a huge complement to the probability of default modeling and attribute sets that are being created and are now being more widely used. But I think ability to pay is going to be one of the most interesting and helpful use cases, because there's a lot of people who look like they have high debt to income, and it's only because they're being fully burdened on joint debts, where the secondary income in the household, other than credit card, that's the only place you can use household income under the regs. They can't get the benefit of the rest of the income in the household. So I'm hugely bullish on ability to pay and the use of this data.
Yep. Alex, are you seeing, like in your conversations, who are you seeing that's sort of being early adopters here?
Yeah, I would say it's similar to Kevin. I mean, I think that where you see the adoption is where, if you kind of think of underwriting as sort of a triangulation between ability to pay, willingness to pay, and an assessment of collateral, you sort of see this really getting early traction where it is weighted more on the ability to pay side, right? And so BNPL is just a good sort of useful example, I think, to think through, because if you think about it, the structure of the product is sort of designed, if we're talking about like pay in for BNPL, the structure of the product is really designed to minimize any risk of unknowns around willingness to pay, right? And so like, if I'm loaning you $250 to buy a couple pairs of tennis shoes, and it's a 6-week term where you're going to pay 25% upfront as the first payment, and then the remaining in 3 increments on 2-week payment cycles, I'm not really concerned about like, oh, do you have a 10-year long willingness to pay, managing all these different types of obligations? Like, that doesn't matter, right? And so in that type of product construct, really, I'm just narrowly interested in what is your ability to pay over that next 6-week period, right? And so I'm looking very narrowly at the debt that you have at this moment and your total household income. And building off of a point Kevin made, this can be really, really important, especially for people who have lumpy income or uneven income, right? I was just looking at
gig workers.
Yeah, like that stuff is huge, right? Because I was looking at the FDIC's report that they do every year on underbanked and unbanked households in the US, right? And they just released the data for 2023. What they found, they asked for the first time ever about BNPL, and BNPL usage is actually much more common in households with that lumpy or uneven or unpredictable income, right? And the reason for that is the product structure doesn't require us to have a really good stable long-term income. As long as I can assess over the next 6 weeks, I'm going to be in good shape to loan you this money. And so I think where you're seeing cash flow underwriting really take off is where the product construct is well suited to sort of naturally be aligned with ability to pay. On the flip side, if you look at something like, I mean, mortgage lending is kind of on the opposite end of the spectrum of all of this, right? Mortgage lending, there's a bunch of different components that go into it. There is absolutely going to be desire for a long time on the part of mortgage lenders to look at your FICO score, right? And to look at your long-term history of managing debt, and long-term sort of stability is going to be a thing that they're going to look at. However, in that context, I think what you're going to see, and we're already sort of hearing some early examples of this, and I think regulators are comfortable with this, a piece of mortgage lending is income verification, right? And looking at income. And again, that's where consumer permission data and providing access to your cash flow data can be really useful. And if you've ever tried to get a mortgage, having a non-W-2 type of
self-employed.
It's a nightmare, right? Like if you're trying to supply all these like 1099s and you're giving them to your mortgage lender and they're trying to construct a picture of your income, the manual way of doing that in mortgage lending means that you're probably not going to get a conforming mortgage. It's going to be hard for the lender to resell it to Fannie and Freddie. Like it's a very, very difficult process. Cash flow underwriting can't do everything in mortgage lending, but it can potentially really solve a specific step in the mortgage lending process that'll be useful for a very specific set of people in the population. So I think where you're going to see cash flow underwriting add value depends a lot on, is it a product construct where cash flow underwriting can be the primary way that you evaluate a consumer, or is it a product construct where cash flow underwriting can add a lot of value for a specific step in the underwriting process?
And, look, the GSEs, which control roughly half the market, plus FHA and VA, which are true government loans, how they go, that's how the mortgage market goes.
Right.
And so it's going to be a little while. I know that there is interest in cash flow data there, and they're looking at it. But in the same way that it took how many years for Vantage to actually get adopted?
A lot of money and a lot of lobbying dollars, yeah.
Right. And the version of FICO that people were using was like from the mid-90s, right?
Right.
So the mortgage market moves slow. It's big. It's our biggest credit product. And obviously, buying a home is a lot of people's families' goals. So I think it's going to take a while. But I believe 10 years from now, that cash flow will replace debt to income. I really think that cash flow, if it's done in the right way, does a better job of representing, because you have a fuller set of debts and expenses, and you can really measure what someone's inflows and outflows are much more cleanly than just using people's debts. Okay.
Right.
So I'm a firm believer that the most beneficial thing that will come out of cash flow data is going to be a better way of representing people's ability to pay.
Okay, so Alex, I think you've had 2 conversations with the head of the CFPB in the last month, if I'm not mistaken.
I have.
So I'm curious to get, the CFPB seems to love cash flow underwriting. In fact, I was actually at the Philadelphia Fed when Director Chopra came up on stage on the day they announced the open banking rules. And one of the, I think it was the very first use case that he talked about was cash flow underwriting. So why do you think the CFPB likes it so much?
Yeah, good question. My sense of that, having spoken to the director a couple of times and followed closely all the rule making that they've been doing around this, is 2 things. I think that the CFPB is sort of naturally suspicious of the credit bureaus and the sort of orientation we have in the US around data privacy, right? And so one of the things that Director Chopra talks a lot about in relation to open banking is we don't have a national data privacy law in the US, right? Like they do in other countries. And so in the absence of that, they really try in all of the individual rules that they build that relate to consumers' data to build in a lot of control for consumers, to protect their privacy, to limit the scope of how their data is used, to be in control of how their data is used. So I think one reason that they like cash flow underwriting is, unlike the credit bureaus and the sort of broader data broker universe, which the CFPB is actually doing some separate rulemaking on to rein that universe of data brokers in and pull them in under the Fair Credit Reporting Act. They really don't like just private companies hoovering up Americans' data and using it for all kinds of different purposes. And while the credit bureaus are a very well-regulated corner of the data broker market, they still functionally are a data broker, right? Where it's more value extraction in a lot of ways than value addition. And so I think one benefit that the CFPB sees in cash flow underwriting is it's a way to put some power back in the hands of consumers, remove a little bit of power and control away from data brokers like the credit bureaus, and sort of balance out the scales and create more data privacy. So I think that's one perspective. And then the other perspective, and I did get the chance to interview Director Chopra on stage at Money 2020. And one of the things he specifically wanted to talk about was competition for the FICO score, right? And so the other aspect to this is Director Chopra's CFPB, and who knows, the CFPB tends to change a lot administration to administration, so we'll see. But at least under Chopra, the CFPB has had a very sort of anti-monopolistic kind of bent to it. And they are very focused on any concentration or market power that is potentially being abused. And Director Chopra talks a lot in his public comments about the FICO score, the fact that there's no real meaningful competition to the FICO score, the fact that FICO has been on an aggressive campaign of raising the price of the FICO score every 6 to 9 months. And so I think those are examples to the CFPB of a lack of competition that is hurting the market and is hurting consumers, right? Because at the end of the day, if mortgage lenders are paying more for the FICO score, they are passing those costs along to you in the form of higher origination fees. And that's not a very transparent part of the market. That's not a place where consumers shop around. It's just a place where more ends up coming out of our pockets, right? And so I think while Director Chopra is realistic about the fact that the FICO score provides a lot of utility as a common standard, and that's not something that you can replace overnight, I think he's optimistic that with cash flow underwriting over time, you will see a proliferation of lots of different types of scores and lots of different types of attributes that will weaken the sort of central hold that the FICO score and the credit bureaus hold on the market right now.
And the only thing I would add to what Alex said is, it's been a while, but if you read the work that FinReg Lab did, I think there's some belief by the regulators that the data is fairer from a responsible and fair lending standpoint also. And I think it ties back to what I said earlier, which is much deeper penetration of transaction data with 96% having a checking account, then you don't have nearly 96% having a deep enough credit file.
Yeah, I mean, the contrast between the CFPB's approach on AI in lending versus cash flow underwriting tells you a lot about that fairness point, right? To Kevin's argument, because, both theoretically have the potential to increase access to credit, which is great, but one of them is a black box that scares the hell out of the CFPB, and the other is looking at your bank account data and underwriting you based on your ability to pay. So one is clearly one that the CFPB feels much more comfortable with from a fairness perspective. And one is one that is scary to the CFPB and others, for sure.
Yeah. And plus, I think in general, the history of CFPB being the primary regulator of the credit bureaus, there's been a lot written about the accuracy of the credit bureau data, et cetera. And maybe even there's a belief that the deposit transaction history may even be a better, more accurate representation of what's happening with a consumer as well.
Well, that's a good place to leave it. Kevin, really appreciate your time today. Alex, thank you so much. It's always a pleasure talking with you guys, and I really learned a lot in this conversation. Thanks a lot.
Thank you.
Thank you for the chance, Peter. It's always great getting together with my friend Alex and yourself.
This episode has been brought to you by Prism Data, the modern cash flow underwriting solution and the team behind the market-leading cash score. If you're interested in cash flow underwriting, now is a great time to reach out about a backtest or proof of concept. Prism has just released the newest version of their cash score V4, which is raising the bar for cash flow underwriting solutions. The new score was trained on a large consortium data set representative of the whole US population, just like a FICO or Vantage score, and includes Prism's cutting-edge data categorization and analytical insights. Lenders adopting Cash Score V4 can increase the number of loans they approve by an estimated 28% without increasing risk, as compared to the prior version of the Cash Score. Prism's latest release also includes tools for income verification, ability to pay assessment, and more using open banking data. Check out prismdata.com today to to learn more.